Welcome to our deep dive into two critical financial metrics, revenue and earnings. While often used interchangeably by the uninformed, understanding the fundamental distinction between these two concepts is absolutely paramount for any ambitious professional, entrepreneur, or investor aiming to truly decode a company's financial health and growth trajectory. Revenue, often referred to as the top line, represents the total amount of money a company generates from its sales of goods or services before deducting any expenses. It's the gross inflow from a company's primary operations. Think of a retail store. Every sale made contributes to its revenue. On the other hand, earnings or net income, the bottom line, is the profit a company makes after subtracting all its costs, including operating expenses, interest, and taxes from its revenue. It's what's left over for shareholders, either for reinvestment or dividends. Simply put, revenue is the money coming in, while earnings are the money you get to keep. The quality of a company's growth hinges on the careful balance and relationship between these two figures, not just the impressive scale of one over the other. While a rapidly expanding revenue figure might initially excite investors and command headlines, true quality of growth fundamentally scrutinizes what happens to that revenue as it flows through a company's operations. High revenue growth can be incredibly misleading if it's not translating into robust, sustainable earnings. Imagine a company aggressively cutting prices to gain market share, boosting its revenue significantly, perhaps by 20% year over year. However, if those price cuts erode profit margins to the point where earnings either stagnate or even decline, then that revenue growth is unsustainable and, frankly, low quality. This is where we shift our focus to gross profit and operating income. Gross profit, which is revenue minus the cost of goods sold, reveals a company's pricing power and efficiency in its core production or service delivery. Operating income, or earnings before interest and taxes, EBIT, goes a step further, indicating how profitable a company's core operations are before considering financing costs or taxes. Strong, consistent growth in these metrics signals that a company isn't just selling more, but it's doing so efficiently and profitably, laying the groundwork for genuinely sustainable value creation rather than just chasing temporary sales boosts.